In this presentation, we will take a look at the decision-making process for managerial accounting, typically the decision-making process for larger types of decisions. This decision-making process can apply to personal decisions as well. As we go through the steps of the decision-making process, note that it might seem kind of self-explanatory. In other words, we might look at these steps and say, hey, yeah, that's what we should probably go through for many types of decision-making processes. But note that many times that we don't go through a formal process for decisions. What we do instead is typically go off of our best intuition, and we kind of run with our best intuition rather than going through a formal set of decision-making processes. That's not necessarily bad a lot of times, because many of the day-to-day decisions that we have to make relatively quickly, and therefore we don't go through a formal decision-making process. However, if we're going to make a decision that's going to be affecting long-term into the future or is substantial in terms of dollar amount, then of course we want to make sure that we take the time to go through the decision-making process. So whether we're talking about our personal decision or managerial accounting decisions, we want to think about what's the relevance of this decision. Does it happen all the time? Am I just following a routine as to what the normal process is for this type of decision? Or is it kind of outside the box? Is it something that's large? Is it something that doesn't happen every day? Is it something that we then need to take a step back and say, okay, this is somewhat of a unique decision that has a relevant impact, and therefore we need to go through a systematic set of steps to make this decision. The purpose of a systematic set of steps is to avoid kind of common pitfalls that we have with the decision-making process. And we'll talk about some of those pitfalls, including like a sunk cost effect, or just moving forward too quickly with our first intuition without basically going through the options that are available to us. So here's the steps we're going to go through. We want to define the task. So first, what's the problem? We want to define it well. If we do not define the task well, then of course we may jump to a conclusion or a decision based on inaccurate information or goals that aren't specific. This may seem pretty self-explanatory, but note that in larger organizations, it's not always self-explanatory, because the problem that comes up might come up in one area, and you might actually have a committee coming together to figure out what the best solution is. And if the head of the committee or the person who has the problem that needs to be solved is not clear about what that problem is, it's quite possible that people that are in the decision-making process, people that are contributing to the decision-making process, don't fully understand what the objectives are of the task. And so we want to make sure that those are well defined to everybody involved in the decision process. We want to list alternative solutions. This is often done in a brainstorming type of session. We're going to have people together and say, hey, give us a list of solutions. Here's the problem. We've defined the problem well. Give us a list of all the different types of things that can happen here to solve this. In this step of the process, we usually do not want to criticize any kind of solution right off the bat. In other words, go ahead and list out the solution, even if it's a little off the wall, even if we know that it's going to have some problems. We're not looking at problems right now. What we're trying to do is list solutions to the problem and get everything on the table, so that we want to be able to brainstorm in order to do that. Once we have our list of solutions, then we can go through those solutions and say, okay, which one of these are actually applicable, viable, work? That's when we go into the critique of these types of solutions and narrow them down to the solutions that are viable. So once we have a viable set of solutions, then we're going to go through and we're going to further gather data in relation to those list of solutions, meaning we got some solutions we think could be possible solutions, and then we're going to go and gather data with relation to those solutions. Based on that data that we have collected and gathered, we'll select the best course of action, the best solution that we will then implement, and of course then we will implement that solution. And then we're going to analyze the decision. We'll see if the solution that we made was good. We'll take a look at the decision-making process to see if we did go in through these steps in detail, log those steps down, and then we'll analyze the process. And of course, the next decision that we make, hopefully we improve on the decision-making process. As we think about these types of decisions, these types of longer-term decisions, these types of bigger dollar amount decisions, these relevant decisions, we're considering relevant costs and benefits. In other words, we want to think about those costs that are going to be relevant to the decision-making process. They're going to be applicable costs to the decision. Obviously, we're talking about costs that apply to the decision we're thinking about when considering them to make a decision about a course of action. Costs that are avoidable. What does that mean? It means that if we make an alternative type of decision, these costs are avoidable. Those are the ones that we want to take into consideration, because if a cost is not avoidable, if it's going to be there no matter what decision we make, it's not relevant to the decision-making process. And that seems kind of obvious, but it's really not, because a lot of decisions that we make, we have costs that are already incurred or costs that we are going to incur either way. And it can be a little deceiving to take those costs out. So as we look through these examples, you'll see where this is the case. And some of those costs are one of the major factors is going to be something called sunk costs. That's one of the problems, kind of like a fallacy that we have in our decision-making process, that we tend to make the decision based on sunk costs that have already happened. So we'll talk a little bit more about that, but just note that relevant costs are what we want to make the decision on. Future costs that differ between alternatives. So if we have different types of alternatives, we're looking for those costs that are going to be different. If we're going to say this is alternative 1, this is alternative 2, and we have a cost that's going to be the same whether we choose alternative 1 or 2, well, that's not a relevant cost. It has no bearing on the decision between the two, because it's going to be there either way. What we want to do is look at those costs that won't be there depending on one or the other decisions. They're going to be different compared to the alternatives. Those are the differing costs that we want to take into consideration when thinking about different options. We also note that out-of-pocket costs are going to be part of the relevant costs. So out-of-pocket costs will be future outlays of cash associated with a decision. So obviously if we have future outlays, we're not talking about past outlays, because if it happened in the past, if the cash is already gone, we already spent something in the past, then it's not relevant to the future decision unless we can get it back somehow. But if it's not something we can get back, it's not relevant. Out-of-pocket costs are those future outlays, future costs that we'll have with relation to a particular decision. Opportunity costs are also going to be relevant costs. Opportunity costs are potential benefits given up when an alternative is selected. Opportunity costs are going to be one of those kind of tricky costs as well that make these types of decisions, these types of long-term decisions, these types of larger decisions or decisions that don't happen all the time, a little bit more confusing, because opportunity cost is more of an economic term oftentimes. It's not a term that we usually see in financial accounting. We don't normally record the opportunity cost, the cost of the second option or the option that was given up in order to pursue the goal that we are going into. However, in managerial accounting, when making managerial decisions, we do take opportunity cost into consideration. So from an economic perspective, note that anything that we do has some type of cost generally. So at least it's going to be the cost of the time that we put into it. In other words, if we have a free day and we can either go to the beach or to the movies, and both of them are free in terms of dollar amounts, and we choose one or the other, if we choose to go to the movie, then the opportunity cost, what we gave up, even if it was a free movie, was the time that we could have spent at the beach. Right? And I mean, if we go to the beach, then we're giving up the time that we could have spent at the movie. So that's going to be an example of opportunity cost. So when we're thinking about alternative options, then we're also giving up the opportunity cost of what we could have done in some other options. And from a finance kind of standpoint, obviously, if we have some money to invest in something, if we invest in something like equipment, we're comparing the return we're going to get on that equipment through operations to the opportunity cost that we could have taken that money and used it for, such as investments possibly, where we could have earned a return on it. So opportunity cost is an important consideration to take into consideration when making larger decisions. It applies both to managerial accounting and to normal kind of decision-making process, everyday decision-making process. Falling into a trap of opportunity cost and not taking it into consideration is something that we are prone to just in normal day-to-day kind of operations as well. Sunk costs is going to be one of the major things that we want to make sure that we have a formal process for decision-making for larger type of costs. It's very common to fall into a sunk cost problem, make decisions that are not valid or not the best decision, not the optimal decision because of a sunk cost effect. The key point here is the sunk costs are irrelevant. They're not relevant costs to the decision-making process, although they're very difficult to ignore and people oftentimes put them into the decision-making process. Sunk costs result of past decisions and cannot be changed by any current or future decision. In other words, we made a decision in the past, and that decision is made. Whatever we paid for it, if it was a financial decision, has been paid. The money's gone. We can't get it back. Therefore, we shouldn't be making future decisions based on the sunk cost in the past. For example, if we have a forklift such as this, we already bought the forklift in the past, then that money is sunk. It doesn't really matter if we're using the forklift or not. If we already paid for it, then it's sunk at this point in time. If we're deciding as to whether we should buy a better forklift or a new forklift, the money that we have already spent that's already sunk shouldn't be in the consideration at this point in time. What should be in consideration at this point in time is the value that this forklift is providing to us here and in the future as compared to the value of the new forklift that might provide to us, as well as the cash that would be involved in the new forklift and possibly maintenance of this forklift versus the new forklift. So when you think about something like that, then it's hard not to include something like the book value of this forklift or the depreciation, not considering taxes. It could have a tax effect. But those things are things that we commonly put into the calculation of whether or not we should purchase a new forklift. And really they're sunk cost effects, because what we actually paid for it in the past is irrelevant as to now going forward. What's relevant is what this forklift is doing for us compared to what a new forklift would do for us, and the outlays of cash that would be future outlays with regards to maintenance or the purchase of a new forklift. And notice this sunk cost effect happens in our day-to-day lives all the time as well. So even things like if we were to buy a ticket to a movie or something like that, and it was going to happen next month, and then a better opportunity came up, possibly we can go somewhere else that we would enjoy more, we might say, hey, well, I already paid for the movie ticket at this time, so even though this other opportunity might be better, because I already paid money for the movie ticket, I'm going to go to the movie. And notice that is another example of kind of a sunk cost effect. If the new trip that came up is better than the movie, the fact that money was paid for the movie shouldn't be the factor that says you're going to go to the movie as opposed to the other opportunity that came up, if the other opportunity is better. If you had taken the money off the table and you had the two things happening at the same point in time, and you were to choose the option other than the movie, and you choose the movie simply because you paid money in the past, that's an example of a sunk cost effect, because at this point in time, you have two options that are two options in front of you, and you should pick the best option at this point in time, not considering the money that has been spent in the past, right? And so this type of decisions, the sunk cost effect is something that's just inherent in our brains, and we typically always take that into consideration. But when we make the larger decisions, we want to make sure we make a formal process to put together to avoid things like a sunk cost fallacy or the sunk cost distorting our decision-making process.